Hi everyone, a very good day to you. I welcome you all to this webinar on Learn Financial Modeling, Add Value and Give Your Career the Boost it needs. We're glad you were able to make it, and I hope it enriches your understanding of financial modeling in more ways than one. I'd like to start by introducing our presenter for the day. Richard Wesson started his career by completing a Bachelor of Computer Systems Engineering with honors at the University of Technology, Sydney. Over the past 20 years, he has held multiple positions in both the private and public sectors, including research and scientific analysis and modeling at the CSIRO and UTS, financial transaction processing, EFT, and settlement at MasterCard, profit and loss ownership and management for Interwoven and Vision 2 Solution, strategic planning and management at Interwoven and Vision 2 Solution. All of these areas have a direct relationship with the creation, management, tracking, and reporting of financial models and results. Richard's mathematical, statistical, and scientific background combined with work in and with many companies allows him to explain financial modeling and concepts with a good balance of theory and practical application. On that note, I request Richard to start with his presentation.
Thank you very much, Austin, and good morning to everybody who's been able to attend. I hope the next hour or so is useful for you. So let's get started. I guess a few opening points is financial modeling is really an area that can create an amazing amount of value to an organization, because it gives it, and doing it the correct way gives us the ability to be able to start doing some predictive analysis or making some projections and things like that when we're working with business. And that really, from a career perspective, is great for anyone, because investment decisions are made based on, in many cases, are made based on analytical work and decision support. Financial modeling is one of the ways that we use, or one of the methods we use for decision support, and I'll go through the tools of that today. So as a brief introduction and agenda of what we're going to do today, I'd like to talk about what financial modeling is really about, and then a little bit about how the market views financial modeling for you as someone who may be interested in a career in this area. Then some of the key tools that are used when you're building financial models, things like balance sheets or balance statement as they're called. We're going to look at what they include and how you use them as part of an input to any given financial model. Just as an example, I thought it's a good idea to grab some information from LinkedIn. They're an SEC filed company in the US, so their filings, their financial data is available, so we can look at that and see how we would take that information as a financial modeler, either new to that company or as an external position, as a basis for our financial model. And then we'll create the financial model, or we'll start creating the balance sheets input to the financial model using Excel, a very important tool for this kind of thing. But a key difference would be how we take the balance sheet, that is a static statement with just text, and then we transfer that into adding calculated data, adding self-checks for a balance sheet to make sure everything is clean, that can then be used as a template for us to do financial modeling in the future. We'll do the same with an income statement, another very important input into a financial model, as there are cash flow statements and share and stock statements and many others that are all direct inputs. After that, we'll switch the gears a little bit and we'll talk a little bit about how EduPristine conducts their masterclasses on financial modeling and how we train both in the classroom and out of the classroom. Some of the things that you might expect to be able to do as a result of attending an EduPristine financial modeling masterclass and the associated work that comes with that. And then we'll look at a little bit about how EduPristine's business model works and their training model works, and why I think it's a great idea and a good business model for anyone considering a career in this area or wanting to increase their skills. So let's look at what financial modeling really entails at a very high level. And it's quite clear, and it's quite common sense, to be honest, that all companies are looking for ways to continually looking for ways to add value to themselves and add their impact to the market. It isn't, however, if you're in a company, it may not always be clear as to what ways they do that. But it's very clear that they're looking for ventures into any kind of profitable projects, and they want to minimize ones that are less profitable. And there are usually an army of people or a group of people either in the company or outside the company working with them as consultants aimed at trying to do that. So every project at Interworking, for example, I did, would go through a financial model where we would look at the profitability of that project. We would then roll that up into the profitability of the company and make a decision on whether that project was a great one, a good one or not from a financial viability perspective. And sometimes if you looked at it from the individual project's perspective compared to the overall project, so the individual project might be very profitable and might have a great amount of revenue, there are actual situations where that could result in the overall profitability of the company going down if that project was in the wrong area or was in an area that wasn't of the maximum margin. So financial modeling was the way for us to then identify what would happen to the company if we did this project compared to if we didn't. And very valuable information could come out of that for investment. So good financial modeling, as I said, helps you maintain revenue and positive cash flows because it also tells you what you should expect and what the effects and the interrelationships on other parts of the business can come in to do with that. We'll see that when we start building the financial model shortly. All of these put together give you a way to establish a business model that maintains financial viability as opposed to a business model based on empirical data. And that's always great. And given that it is a mathematical representation, it has some rigor and some method and detail and discipline around it in order to make sure that that mathematical model remains intact. That can only be good when you're building your financial model. One thing I'll also point out, though, is a financial model is not a theoretical tool. Financial model takes real data that's measured. It takes real experience from people, and the mathematical side of it and the statistical side of it is describing how that model is behaving, and then it is used to compare against things and continually moving forward and continually being optimized. As a financial modeler in any kind of organization, your job is to set it up as a best practice and then continue to monitor it and make alterations to it along the way to make sure that the data that's coming out of it is one that can be as trusted as possible. So I want to make sure that people understand that this is not just an area for people who are mathematicians or statisticians. This is an area for very much a big input to this is also people who are very practically minded and looking at the business as a whole. So some of the reasons we do financial models is, one, we want them to be mathematically sound. Okay? Yes, it should be simple. The model should be simple and it must have clear descriptions and assumptions around it. It should also be mathematically sound. We can't have a financial model that doesn't follow general maths or general statistics, because if we do, we're no better than guessing. Once we've established a mathematically based financial model, and that isn't really that hard, but once we've established that, we can start using it for projection information and saying, if we were to do this to our cash flow, make this change of our days outstanding on payments or something like that, how would the rest of the business react to that? What would it prevent us doing? What would not prevent us doing? And it can ultimately give us a bottom line value or an estimated bottom line value if that situation came into play. So that's great from also a reactive analysis in case something happens in the market, or it can also be a proactive analysis when we're saying, well, what if I did this next year and I started making my investment decisions? Now, if you can start understanding or recognizing that if you're helping the what-if analysis to investment decision makers, usually senior executives in a company, your value add is significantly higher than if you weren't doing that. And you are effectively being introduced and included in conversations that support those decisions as opposed to conversations that are to implement those decisions after they've been made. It's a very clear different path that you would take and higher up in the food chain. Now, as I said before, it's a mathematical model. It is an analytical and potentially predictive tool. Now, I would say analytical tool, absolutely. A predictive tool, it's predictive when you ask it the right questions. And in the MasterClass, we would go through situations where you could ask the wrong question or not ask a question, and then the financial model is not much help. However, if you ask questions to it in a structured way, and there's a technique for doing this, then it's very predictive as well. And it's not just individual companies that use financial models. It's also many external companies. It's analyst companies, it's market analyst companies, it's stock market companies, things like that, using financial models. And one of the most common ones, or the two, are one's the DCF, or the discounted cash flow models, and that's one way of doing evaluation of a company. Industry comparables is another. That's another way of saying benchmarking. So we're not using something that is not well recognized in the industry. So let's say you went into financial modeling. What are some of the job titles that you might want to look at if you are searching for a job after you have some qualifications? Well, there are a whole number of them. Here is just a few of them that I'll point out. One that I personally hired and continually hired over many years at Interwoven and Vision Solution and also at SEMA was a manager of financial modeling and audit. And these people worked directly with me in the business to be able to say, anything we do, we need to make a business decision based on a customer. We need to make a business decision based on some event that's happened in the market or in the company. These people would then come back and say, can we afford to do it or not, and what is going to be the impact to other parts of the business that would help me define whether that decision was a good one or whether I needed to wait or relax a little bit. Based on that, the manager of financial modeling would be someone who would help me with that work. There was also project managers who deal with financial modeling and on a bigger scale, equity research analysts, retail and auto, or any other company that's doing equity valuations and things like that. Austin, can you hear me okay? I think I might have had a power failure. Austin, can you hear me?
I can hear you, Richard.
Okay, so all the lights have just gone out in my hotel room here, so I'm wondering if I've had a power failure. But if you can still hear me and see my presentation, we'll keep going. It doesn't appear to be any emergency or no alarms have gone off, but if you hear an alarm, we may have to reschedule. Okay.
Okay. I can see it right now. I can.
Okay. Thank you.
Yeah.
So as I was mentioning before, equity research, market data, quantitative analysis, and things like that. These are all career and job titles that you might come across when you're looking for financial modeling jobs, and they all fall within the same area. But what I would suggest is they're a good way to start searching if you're interested in who's looking for financial modelers and what they might be paying for that. Another area, as it says, it talks about business analysts for real estate, but it's really business analysts for anyone and for any kind of topic, because a business analyst works very closely with a financial modeler, and often they are the same person, okay, or they are in the same team. So it's a good idea to not limit yourself just to something that says financial modelist, research analyst, or business analyst is another good name for that. And as we can see, financial modelers and business analysts and people like that have a relatively stable income, and it is increasing more than inflation. That means that it's something that companies are viewing as important for decision support and for making investment decisions more and more, because it's like an investment in good decision making, a bit like when you go to a financial planner, ask for advice, and there might be a fee associated with that. Now, the trend always goes up and down in any given case, but back in October 11, as you can see, the salary index was 1, so that's when they started tracking this information. It went down a little bit, but didn't go below 0.9, didn't actually even reach 0.9, and then started increasing again. Now, by looking at this graph, the salary index also doesn't refer to inflation, so one thing you can actually do is say that stability when compared to inflation is actually a good thing for career and for salaries as well. So I would suggest that it's a good market to be getting into with the right skills. Now, there are a number of skills that are required for financial modeling. Now, as you can see, financial modeling in bold up the top is one area of that. There's a lot of skills in demand around sales and accounting, as there always will be, audit and tax from a compliance perspective, risk management from a company's perspective. Financial modeling has become a key part, and it actually does cover more than just what is shown in here, because accounting feed into financial modeling, and often the financial modelers come back into accounting to say, we need to capture this data to continue making good projections. Financial modelers link directly, very clearly and very commonly with risk managers to say there is extra risk beside this given project, but there are extra risks that need to be taken into account as well, and that's coming from the analysis from their financial models. So if I was to summarize a little bit about what financial modeling is, and these are more in my words now, but it's really a way that helps us understand how the business is performing financially, and it's using generally accepted financial reports. So if I use from the previous example where I was talking about accounting and sales or risk management, though the outputs that are generally accepted from those areas are the inputs to financial models. So we don't need to go and create data anymore. We can find data fairly quickly. And the really good thing about it is, for example, if you look at sales or if you look at accounting or risk management, everything's based on historical data, but it's not projected. Accounting is up to a given point in time. A profit and loss sheet is up to a given point in time. A balance sheet is up to a given point in time. It is not an ongoing projectional tool, and that's where financial modeling comes in, because those projection tools allow for what-if analysis to be done on that data. It can be large data in what they call big data warehouses, or it can be something as simple as a balance sheet like we'll show today. Doesn't really matter what it is, what we're looking at. If we ask the right what-if analysis to that, we can make some good predictions, or at least get some picture and visibility on how the business might be moving. Big companies and even small companies do this every day because they have to create these reports for tax purposes. They create them for filings. So the data is readily available, and also executives who are making investment decisions are very, very interested in understanding what the data might also be telling us. One key important thing is to always create a best practice on historical data as your template, and then use that for projections, because your historical data has all of the balances calculated. You can make sure that there are no mistakes, and that template then becomes something you use. One thing I would like to point out, though, is there are many tools out there for financial modeling. Some are commercial packages, some are things freeware packages or open source packages like Gretel, commercial packages like SAS. One thing that is important, though, is all of them require some initial data manipulation, and something like Microsoft Excel item numbers is a very good tool for that. So today we're going to look at that, and it is very important that you maintain those skills. There are some tricks of the trade that financial modelers get, and I hope some of those will rub off. So let's start with the inputs of the financial model. We've got the balance statement and then the income statement. So we're going to go through and build one. A balance sheet or a balance statement, they're interchangeable terms. Usually depends on the country you're in. They show the financial position of any given organization or department at any one point in time. They're not a predictive thing, they're a history. They're over a period of time, and they finish at a given date, down to the day. They include assets, liabilities, and owner's equity as the key portions, and what we do is we actually have assets and then liabilities and owner's equity together. They should cancel each other out to make sure that we are in balance. If I was to put that in a diagrammatic form, on the left-hand side we have the assets, and the right-hand side we have the liabilities and the owner's equity. Now let me give you an example of why these are on both sides. An owner starts a company and brings in some equity with them. It could be capital, it could be some kind of property or some equipment or whatever that term is, but it's physical assets that the business can now use. Often in the case when the business is either a public listed or even a private company, they have some form of investment as well. Creditors, we have to pay back. They're not, but they are money that's available for the business to use. So if I add those two together, I get a total list of assets that are available to the business at any given time to be able to work. So cash is an asset. A plant, and it might be a factory asset in a big manufacturing company. A mine might be an asset for a mining company. Assets can also be less tangible, things like a patent or a royalty thing in the music industry or something like that. So it's something that's owned, it's something that's available to the business. It can be used as a security for a liability loan. It can be used to actually make an investment. But the two must be the same. So the assets must equal the liabilities and the owner's equity. And if they don't, that means our balance sheet is not in balance. So the name balance is specifically about making sure that everything's on one side is also on the other side. This can be a little bit confusing for first-timers or when they're dealing with balanced accounting, because we always think, well, hang on, the liability is something on the right-hand side. It's not something that I own. But if you consider it this way, if I go and borrow some amount of money from an investor or a bank or something like that, I now have a loan resulting in a liability that I must pay back. I also have that bank's money to be able to use for my business. So I have an asset that I can make use of, and that's why it's a balance sheet. Diagrammatically, again, we sort of put them together. Notice the boxes are the same size, and it's on a little balance scale down the bottom here. All right. A balance sheet should always be in balance. That means everything, if you add everything on this side, it should have the same number as here. The more you have, the more liquid you have, the greater liquidity you have. And if you look at one side as where the money is coming from, is really where the equity and the liabilities come from, and then where it's going to go to or where it's going to be used is on this side. So it comes in one, balances, and out the other. There are sometimes off-balance sheet items that aren't necessarily relevant. We won't really go into them today, but if they are there, they'll be written with some note and assumption on that particular balance sheet. So here's what a balance sheet sort of looks like, and it's going to be for the company LinkedIn. We're going to build this, so we won't spend much time on that. We'll talk about how we get the data. What's important is some of these areas are calculated values, other are just registered and measured values. We need to understand the difference when we're creating the model, so our projected things calculate for us. So let's have a look at LinkedIn. If you were to go to this particular link, actually I'll click on it and we should be able to go to it. Let's go to Firefox. As we can see, this is the filing statement for LinkedIn. They have annual reports, the 10K reports. They also have quarterly reports, the 10Qs. They'll appear in a second. What we are interested in is the annual reports. Now, imagine I'm a financial modeler who's just started at a company, be it LinkedIn or a company that LinkedIn is using to create financial models. I can immediately go and get this data. I can download the Excel files of it. I can download a PDF file. Also, I can use what's called the XBRL, Extensible Business Reporting Language, that many of the packages support, or I can view it online. Now, I've already downloaded these, so we don't have to waste our time with downloads. But the point is it's now readily available information. Let's see what that information actually looks like, though. Here is the Excel file. As you can see, there are a number of tables down the bottom here that we're going to be looking at. And here is the PDF file of the particular area that I'm interested in. It's a rather large document, but I'm interested in the balance sheet. And what the PDF file tells me is how LinkedIn grouped things together. So they have the indentation, where they summarize, things like that. As someone who's doing modeling for LinkedIn, I want to know how they view things and how they group things, so I can position my model that way and then report on that model and provide outputs from that model the same way as they view it. Okay? So that's all I'm going to look at the PDF file for, just to get an idea of that. All of that information is available through the SEC filings. And let's open this real file. Here it is. So if down all these tables, all the information is related to what the SEC requires publicly listed companies in the US to provide. The Nikkei has their own requirements. Any LSE in London and the United Kingdom has their requirements. Having an idea of what those are, so be it quarterly reporting or just yearly reporting, it differs on the stock exchange. But understanding what they are means that I can get access to information very clearly. Now I can see this thing called balance sheet. And what I see is a whole series of assets. I see some notes about it, and I see them for 2012 and 2011 as of December 31st. Remember, I said a balance sheet must have a specific date that it's valid to. So I can see a whole series of assets down here. I can then go down and see liabilities, stockholder. One thing I also notice is I see, let's say for cash flow equivalents here, I see 339,048 thousands of data. So that's 339 million. What I'm noticing though is that's a written value. That actually comes from a different spreadsheet here called the cash flow one, another model. So that number will be down here somewhere. Yeah, cash flow and equivalents, beginning of period, and then end of period. These are also going to be calculated values. So what I'm trying to point out here is these different inputs are directly related to each other. So if you set up a good template, then you can make a prediction on cash flow. Then you can see that fall through into here, and then you can make a question about expenses and have everything fitting together. So to save time, if I was doing this for real, I would then just be copying and pasting these values, except the ones that are calculated values, into a new spreadsheet. But to save time on this webinar so we can spend more time talking about the valid data itself, I'm going to go to one that I've pre-prepared. So this has the balance sheet as of the 31st of December. Notice I've got these yellow sections. they're going to be either calculated values or values coming from somewhere else, whereas these blue ones are just actual values. They're measured values. So in financial year 2002, the short-term investments totaled this number. So what we would then go through is, or we do that formatting just so we can read the model, we understand the model, but then we would go through and work out what needs to be calculated values and what that calculation should be. So total current assets is pretty simple. It needs to be the sum of all of these. Now remember I said that the cash in the business is an asset, so it has to include the cash and cash equivalents too. So that value there, the same thing here. So then total assets is going to be the summation of all of these, because that includes assets that are not necessarily just current. So we sum this, and we do a sum of that. And likewise, in the liabilities and stockholders equity, we need to sum these ones up, and so on. So our total liabilities is going to be the current plus the long term, just like it was with the assets. And stockholder equity. Now, there's a few things that have been done here that I'm going to explain in a minute, but let's just put the calculations in first. And then total liabilities and stockholder equity is really two values. So equals this one. So total stockholder equity plus stock. Right. Now down here, I can see I have a check system. So part of the best practice is, remember we need to have stockholders and liabilities equal assets. Because without that, then we don't have a balance sheet, and that means that there's something wrong with our model. I've put in a little function here for a balance check. It says, if these two aren't the same, mark this as false and then tell me the difference. I know that they're not correct at the moment because I haven't put the cash flow information in. What I would then do is I would go either to here and get the cash flow information, or I would go to where the real data for the cash flow is and say, oh, okay, so now I know what my two values are because they're listed here. So for 2011, the cash flow at the end of the period is that. So I go into my sheet. Now I already know what the value is because it's written here. Okay, so I'm just going to put in that value as a 339048. 339048. And now my balance sheet is correct. So we do the same on 270408, I believe it is. Yep, and my balance sheet is now correct. In a real situation with the financial modeling, I would have another spreadsheet that says cash flow that would calculate these values and populate them into there for me. Okay, so the balance sheet would be able to take the cash flow as an input. It would also take the stock as an input. I see stockholders' equity here. It tells me how much money came from stock, how stock was put together, and also in the balance sheet, I see down here it talks about the Class A and Class B stock. It's a bit hard to read. So Class A stock is just regular stock that anyone can buy. Class B stock is stock that has extra voting privileges. Let me give you an example. A founder might have 10 votes per one share, whereas a stockholder might only have 1 vote per 1 share. Now, if my model was interested in changing the stock allocations of Class B and Class A, I would keep these separate. But typically, that's a pretty significant thing in the industry. You probably wouldn't be doing that so often because it requires significant approvals and things like that. It looks a bit strange. So all I've done is I've put these two together. So the number of stock for 2012 is 11, and the number of stock for 2011 is 10. So all I did is I just grouped them together, and I called it Class A plus Class B common stock, and I added them together. You see 4 plus 6 here, and you see 9 plus 2 here. If I was interested in having them broken out, I'll have them in 2, and I'll put 9 and 2 in. But once again, all the information is directly available to you, and you can allocate and you can identify it from looking at the raw reports. So now that I've done that and I've checked that everything's balanced, all my calculations appear to be correct, I could then extend it out. And here is where the financial modeling starts, because this isn't filled in yet. I'm going to go to the filled in one instead because I was just creating the unfilled one for you. If I bring up this one and I go balance sheet projection, these calculations are already coming in. If I now wanted to say, all right, well, this next year I want I'm going to move these values across. What if my cash flow drops? Oh, actually, what if my cash flow drops? Or what if my prepaid expenses increases to this? Now the model starts recalculating and tells me what I need to be able to compensate on the other side. So these are relatively simple calculations. The point is, the model is now doing everything for me. I can start making adjustments to accounts receivable, deferred commissions, intangible assets, depreciation-related information. I can start doing that and see how the whole business still comes together, or what adjustments I need to make in cash flow, for example, to make that still appropriate. And so then I can ask myself the question about whether this investment decision is good from a cash flow perspective or whatever. There are really a number of possibilities here. I'm just trying to show that the projections become a very interesting little tool. So just moving back into the balance sheet example, this is just an example. This is just showing what we've just done. We copied them through. We ensure that we have the right dates. We put in the units of the thousands of US dollars. We can do some formatting to make sure financial year comes in or predicted year comes in. These have all been done through custom formatting. I'm not going to take you through that because most people can use Excel. Very important though, we had to put in the date of when the data was measured to. Our projections are for any amount of time, but the data was measured to that point. And I pointed out that the cash and the cash equivalents come from the cash flow statement. This is summarizing again what I've done, so you can go through it yourself. And to the point where we get to a formatted balance sheet that looks like this. So another very important input to any financial model is the income statement. So let's talk, like we did with the balance statements and the balance sheets, let's talk about what the income statement needs to have, and then we'll go through and look at, again, creating a template for that and how that's used in the model. So the first thing is the difference between a balance statement and an income statement is it shows a financial report over a period of time. It's not as of one date. It's income over a period of time. You've probably heard governments talking about forward estimates, or you've heard about companies talking about over this particular financial period. That's where the income statement comes in. And it's using terms that are much easier to communicate with the general business, so the revenue or the inflow of money. Expenses are the outflow of money. We're not talking about assets and liabilities now. Gains, losses, or sometimes known as profit. So it gives you a way to be able to communicate it back. Now it uses the same concept with all revenue on one side, being on the left-hand side, and going through to how that revenue is used to pay for things and where taxes come in and various other things along the way. So, as you can imagine, revenue has to pay for people, has to pay for overheads, pays for various things. Depreciation, for example, and amortization are not cash expenses though. They're entries in the book, wages and things like that. And you can see where income and profits and how tax comes in. So we have this little formula up here, the EBITDA. It's EBITDA, or pronounced EBITDA, or EBITDA, stands for the earnings before interest, taxes, depreciation, or amortization. Every company produces this information and shows how it's broken down. And it's a good way to say, okay, what are my earnings before income tax? Before interest, because interest is also an earning, but I don't want to cloud my sheet. Before tax, before depreciation, because we have to depreciate values of assets, that's an accounting tool, or amortization over time. So you'll come across this a lot. And as we saw in the balance sheet, we want to format our income statement so calculated values are done correctly versus real values. And instead of going through the whole process again, I'm just going to go to the filled-in sheet and point out that these blue ones, the net revenue is a value that's measured. You know how much you sold, you know what your revenue was. And the costs, the accounting team are maintaining these all the time. So the total costs and the expenses is these two values, and these two values should equal this value. If you look at that sheet before, all the revenue should equal all the costs, including those things. And then we have other income, income before taxes, and these are values for us to look at, and then our net profit. That's basically this value broken down. Once again, we could put a check function in here to make sure it's balanced, and in a good financial model I would do that. I just haven't done it yet. But the bottom line is this should equal this plus this. And in this case, it does, meaning our model is balanced. So we could do the same thing with projections like we did with the balance sheet over time, and we can say, okay, if our revenue increases, our cost of revenue needs to increase by a certain percentage. Well, what about these things? Do we have a way to lift our profit? Like we see here, there's been a significant lift of profit with a significant lift of revenue. So that brings me to the end of the actual examples and how we do these kind of calculations. I'd now like to talk a little bit about the classes. If you wanted to go into this, we'll go through all of these in a great deal of detail, much more detail than I have shown here. I'm just trying to give you a taste of what kind of things you would see. So the MasterClass that EduPristine provides for financial modeling consists of 4 days of intensive classroom training. That training is done by people like myself, who are dealing with this stuff every day, either as part of their job or experts or sometimes academics, and whomever that is, who are well suited and well experienced to be able to explain that area of either financial modeling or some other thing. So 4 days is quite a lot. As you can imagine, we do a lot more than we've done now. And you'd have personal access to doing it. You would also get to take away some of the things that we do. So I just showed you the unfilled and the filled in Excel templates to practice. Also the models that we create. So we would add the cash flow model, we would link that in there, the workbooks that come with that. The whole idea about modeling is what you invest your time in creating a good template that you can use, and then you optimize that and tune that as you go forward, as opposed to having to do it at the same time every point. There's offline or online material as well, so there's videos that allow you to study at your own pace. So because the 4 days is time bound, but the 20 hours of video you can do it with over a larger period of time gives you the ability to then have training from a certain person, but also training from the people who develop the content, put them together. It gives you a better idea of what's going on. This gives you more time and more repetition. We also have this concept called doubt clearing. Now, doubt clearing is a way, it's like a forum. It's a way that trainers typically monitor as well. It allows you to ask questions through into a forum and get your questions answered, because typically one question that you have, most other people are going to have something similar. And last but certainly not least, is it's very, very important to note that these courses are financially recognized and internationally recognized for either credit hours, for advanced standing in a larger degree, or as a certification. It means that whatever certification you receive, you can take that with you and have it internationally recognized. So what might you be able to do at the end, and what kind of rewards or benefits should you expect? First is you'd go through the more disciplined approach on how you create a robust and easy to maintain or easy to tune financial model, because they are going to change over time. And that's fine. They should change. The business is in a changing environment. Then what you want the model to be as accurate as possible. And by building using the best practice to build a template, you can reduce the errors. It's quite easy to copy and paste errors, but if you have the checks in there, if you have the true false, and also the balance check and the difference that I put in there to tell me how different it was, be it positive or negative, that helps ensuring that the model is clean. There are many pitfalls and many common mistakes that we've all learned over the time and how to try to avoid. You go through the same thing. So I already pointed out my best practice is not only putting the balance check in, but also the difference, because it gives me the easy ability, if I make a common mistake, where to find that, because we all do. Now, if I've done this and I've shown that I'm using a lot of experience from not only my own, but from other people who are experts in the area, it's really going to mean that my work stands out from somebody who's just gone through and read a book. So really what we're trying to do is to say, by having an industry expert or a well-experienced person teaching these things, you can get a lot more from their brain and from their network, because they are now part of your network in doubt clearing, to make sure your work stands out. That's great for your career. That's great for value add to your company. So I think it's a good model to have. And along the way, because we're using Excel or any other package for that matter, because we need to, we're going to discover some features, and it's a great way to be able to share information to do things more quickly, increasing productivity. Now, EduPristine offer batches of training, typically monthly, but also as on demand in multiple locations. Now, I'm not talking about any one particular one here for anyone. I'm saying that this is the model that we're using. So depending on where you are, depends on when that training is going to be and who would be training it. What I would indicate, though, is they are quite good at getting back to you as to where that's going to be and then arranging a trainer like myself. the way to get in touch with them is either through the number here or the email address. You will get contact quite quickly. Many of the people, the business development contacts for EduPristine that I've worked with have looked after me. Austin is one of the ones on the line now, and depending on which country you're in, there are different people. But if you go to Help at EduPristine, that will direct you to the right person. I certainly can say the people in Australia have been very responsive and looked after me well when I've needed their help as well. So if the trainers say that, then the students should also be comfortable. So I'd like to finish off now just a little bit about the profile of EduPristine, and then we'll have some time for any questions after that. I think the company is well founded. They have a number of courses. They have a lot of online training. They have a lot of classroom-led training, and the mix of those together gives a good grounding for anyone wanting to go into this area or wanting to extend their skills. The locations, there's a large number of locations, and that's important to note that this classroom training in different places is done by locals in each one of those places. And by doing that and having a local do that training, you also get a better understanding of not only a local network, but how things are done in that particular industry, in that particular geography. Financial modeling is a global practice, and it is a global skill. There are, however, little idiosyncrasies based on different tax laws, different compliance laws in different countries, and getting a local who is in the industry in that area helps quite a lot with that. So I think they have a nice business founding, and with all the certifications for that that are relevant to each individual geography, it can only be good. The team that have founded it, both the investors and then the founding directors, are coming from very reputable organizations, some of which I've known. So there's good grounding in the people and the kind of culture that's been dealt when they set up the business model, not only with the people who are direct employees, but also the people who are trainers like myself. There are a number of customers, many in the Fortune 500, that I think show that this is obviously a good business model. I'll talk about them a little bit more shortly. And I think it's important to know that not only is the training clear, but it's come with hands-on case studies, and often trainers like myself will bring case studies in when we're conducting the class that are real examples of what we've seen in industry. Given that, you get more information about that, you get a better grounding. The online material is also very, very helpful. It's learning at your own pace, so what that does is it gives you the ability to get blasted and a lot of information in one particular training course. And I, as a trainer, also point to various areas of the online training that I think are good either pre-class or post-class for any given day. Last but not least, what is provided is the models that we generate. Become samples part of your toolkit for later use. Again, I don't have any intention for you to have to go out and rebuild and reinvent the wheel so often. I mentioned the certifications, international certifications. CFA is a big one. PRIMA is another one. The others are GARP and FPSB are important if you're in India. So what I would suggest is that these are good things to have on your CV. Now, if I can talk about how Fortune 500 companies, just for a minute, deal with trainers and when they're selecting training providers, it may not be as simple or as obvious as just saying these names here, but I have personally, through many different parts of my career, dealt with all but one of the companies on this slide. The one I haven't dealt with is Franklin Templeton. I can't comment on those. But Ernst & Young, Bank of America, JP Morgan, Mizuho, ING, I've dealt with them in Japan, I've dealt with ING in Amsterdam, HSBC in Hong Kong, Credit Suisse in Japan, JP Morgan in the US. And as a trainer for them, when I was training various things, not specifically financial modeling, but of any kind, they actually used to interview me to determine if I was appropriate to train their staff. They were very particular about the content, very particular about the trainer, very particular about the organization of the training and the examples. They wanted to make sure that they were making a good investment in their staff and the training they had. And I had to be, HSBC interviewed me multiple times from different departments, JP Morgan did the same. And what this shows is because they're quite particular and they're quite rigorous in their selection of a training provider, just having these names here shows that the EduPristine model, just like I have said, is a good one, and they must have good trainers because otherwise they wouldn't be able to get these things and to get these kind of customers. And then if we take it one step further and say, well, there are educational institutions that have also contracted EduPristine and people like myself to do training. The ones on this list that I have personally dealt with is the National University of Singapore, who are very particular about their quality of education. It's a very competitive market in Singapore, and I spend a long time helping them formulate a number of different workshops, both on training to undergraduates and postgraduates, but also training to internal staff. So once again, EduPristine have a lot to be proud of here, and I'm quite proud to be part of that. It happens all across the world. There's online training and classroom training that happens in just about every continent. So you can see down in the Australia, New Zealand area, going into Asia, even into Europe and Russia, down into Africa, South America, and of course North America. It means that there's a good grounding, so if it's a global organization looking for a single training provider, that works. If you're in different places and you travel around a lot, that works. Consulting companies who go where their customers need to be, that works. I think it helps in making sure that you get consistent and smooth training environments for a company. There's a large number of courses that are taught in a lot of different areas, and again, the beauty of the business model, I think, is given the large number of trainers who are coming from the industry. They're not people who are just hired as a trainer who have to train everything on this sheet, but they're actually people who are brought in, like myself, with business expertise in various areas. We do this training. So, for example, I do data mining, basic statistics, predictive modeling, FRM. But I don't do, for example, things like real estate modeling. I don't do things like equity validation or Basel III, because Basel III is something that's specific to Europe. It's better to get somebody who is specific to Europe, who deals with that stuff, to work with that. I do, however, do economics and markets and quantitative analysis. So what they do is they create this sheet, and then they create, for each geography, they'll create a list of trainers who are skilled in those areas, so they can provide a full offering to people and to companies related to that. So with that, I'd like to hand back to Austin to open up the floor for any questions that you may have on both the webinar or the industry or financial modeling in general. And with, Austin, please open up the line for any attendees who have any questions. Thank you.
Thank you, Richard. The presentation was indeed very enlightening. If anyone has any questions, you could just post your questions and send via chat, and I'll read it out to Richard. And for those of you who might have come a little late, there will be a recording of this video available in about half an hour, 40 minutes. So you can go through it whenever you wish to. You just have to click on the same link and you will be able to view the recorded video. Any questions? Right, so Royce is asking, how much does it cost, and are weekend classes available in Hong Kong? Yes, classes are available in Hong Kong. What modes are the deliveries of classes? What do you mean by that, Royce? How is it delivered? Do you mean live or recorded or something like that? Okay, yeah, they're live classroom sessions. As for the cost and the dates, I will get you in touch with, I will tell the concerned person and he will get back to you, if that's all right. Okay, sure thing. Anyone else? Does anyone have any further questions? If nobody has any further questions, I think we can terminate and conclude the webinar. No questions? All right, then I think we can conclude the webinar if nobody has any further questions. Thank you all for coming, and stay tuned for more webinars. We will be having them soon. Thank you all once again, and I hope to see you soon. Thank you. And thank you, Richard.
Thank you very much, everybody. Thanks very much, Austin.
Yeah, bye-bye.
Yeah, bye-bye.